If you have a cash reserve or an emergency fund, those dollars really should be in a high yield money market account. However, there's been some big changes, one in particular to money market accounts just recently. I want to draw your attention to. Got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. During your career or even in retirement, you should have a cash reserve. You should have an emergency fund. I prefer to call it a financial confidence account because while it's very rarely going to be used for an emergency because they don't come around that often, every single day it gives you financial confidence, and that confidence comes from you knowing if something happens and I have an interruption to income or a surprise large expense that I just wasn't planning on, I've got some dollars sitting right here that I can tap into. I don't need to reach for a credit card, which are at record high interest rates, by the way. Don't need to dip my hand in the cookie jar and pull dollars out of my retirement account or take other extreme measures. I've got some cash right here. If you don't have that set up, oh my goodness, I can't encourage you enough. Make sure you work with your CFP, get that system set up and have a chunk of dollars, have a cash reserve, have that emergency fund set up. So where should that emergency fund be? Should it be invested? Should it be in a CD? It should be in a high yield money market account because those dollars, they need to be liquid, okay? They need to be accessible whenever you need them, and they still need to be FDIC insured and safe and secure so that when you need them, you can trust that they're gonna be there. But aside from that, you just wanna get the best interest rate possible. And not to mention, with how interest rates have moved the past couple of years, more and more people have been more comfortable or satisfied with just throwing more and more dollars into a high yield money market because it's been paying so well, or for that matter, a short-term CD. But when you think about interest rates and what you've heard about interest rates just even over the past few months, yes, you've heard the Fed has been lowering interest rates. They've dropped them 3 times in 2024 from about a 5.375% level to currently, at the time I'm recording this video, about 4.25, 4.5%. So dropped them 3 times. So I'm sure you're aware of that. But along with that, you've also heard, again, and under the heading of interest rates, that the Fed didn't drop interest rates as much as they expected, right? The markets were expecting 5 to 6 rate cuts last year. They didn't do that. And that rates are probably going to be higher for longer, right? And because the Fed has said we might only be able to cut interest rates 2 more times in 2025. There's even a big prediction out there that Fed might need to start raising rates again later this year. So rates are going to be higher for longer. And you might have also heard that mortgage rates have gone back up. So if that's what you've heard about interest rates, you might be thinking, yeah, I'm assuming my money market is still paying a decent interest rate. It's still probably pretty competitive. And if you've got an emergency fund there, or if you've had more and more dollars kind of set aside in these types of investments or vehicles, you might say, yeah, I'm still probably getting a competitive rate of return. Money markets, high yield money markets, and for that matter, short-term CDs have moved very differently than what you've expected if you haven't been looking for it. They have moved very, very aggressively based on the Fed's moves. It wasn't difficult 6 months ago to go out and find a high yield money market paying 5% or 5.25%, or some short-term CDs, 9 months, 12 months, 15 months, something like that, paying above 5%. That was very, very common. And yet that's just 6 months ago. It seems like overnight, not a lot has changed, but now you can't find those interest rates anywhere. In fact, I was working with a client just recently, and high yield money market accounts, and by the way, that's the title, but high is relative, as you'll see here in just a moment, they're paying around 3.8%, below 4%. And again, if you're listening to the headlines, you might say, well, the Fed has lowered interest rates to around 4.5%. And a lot of other interest rates are staying up, staying high. So I'm assuming my money market is as well. No, drastically different story. CDs, short-term CDs and money markets rates have absolutely plummeted, even though mortgage rates have gone up and a few other rates are staying high. In fact, even just preparing for this discussion, this video, I just searched, obviously, the high yield money market that I use and the ones that we typically recommend to clients, and they're all 3.8, 3.9. I did a broader search and found one or two, just a couple, that are still at 4%, but that is very, very rare. So what do you do? And here's why I bring this up, because I think it could be tempting. Now you have that high watermark. I should be getting 5% of my money. I'm not, therefore I've got to do something. And oftentimes when you feel that way during this environment, that got to do something means, well, I need to take more risk in order to get that higher return. Or maybe you don't even realize that connection. I've got to go out and get that higher return. How do I do so? And you don't realize the way you're going to do that is to take more risk. No. For an emergency fund, for your cash reserve, the purpose of those dollars isn't to make you rich. It's to keep you from going poor. And if the interest rates have moved in such a way, in a bizarre way, like we're seeing right now, where they have been very sensitive to the Fed's reduction of interest rates, it is what it is, right? And so don't feel this need to, oh, I'm at 3%. Now I'm being taken advantage of. I've got to make some significant changes and maybe take on more risk. No. You want these dollars, your emergency fund, you want those dollars to be liquid and to be FDIC insured. You also want them to be free. After that, get the highest interest rate possible. And right now, if that highest interest rate possible is below 4%, so be it. If you're well below that, if you're 2.5%, or a lot of savings accounts at the banks are 1 or 1.5%, you've got some work to do. You've got to move those dollars into a high yield savings account to at least get a more competitive rate. And then the other side of that is true as well. If you're one of those individuals that's gotten comfortable, where maybe you've put more dollars into high yield money markets or short-term CDs than you otherwise would for an emergency fund, and now you've sort of used this as part of a long-term investment, now that's something to work with your CFP on. As these interest rates have come down in these money markets, probably not appropriate to have long-term dollars there. And you're going to want to work with your CFP to see, well, what's a long-term vehicle to be using since this interest rate isn't as strong anymore. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.